Real Estate, Money, and More, Episode 12.
You finally found it. Welcome to the show that helps thousands with real estate, money, and a whole lot more. Now here is our host, best-selling author, Shane Willis.
Well, hello. Welcome to the podcast that talks about exactly what the title says. We're going to talk about real estate, we're going to talk about money, and we're going to talk about a whole lot more. I'm your host, Shane Willis. Let's do this. All right, thanks for listening to this week's episode of Real Estate, Money, and More. I have got a special episode. Matter of fact, I brought in a guest, and if you guys are a long-time listener, you know if I'm bringing an attorney in, you know it must be important. I'm bringing a guest because everything changes August 1st. August 1st, 2015, everything changes. All loans, closings, that have loans are pretty much required for this new change, this new law that we're going to talk about in this special episode of Real Estate, Money, and More. Now, I shouldn't say all. I hate using the word all because there are some exceptions, aren't there always? But for the most part, any buyer or seller that goes under contract or a loan is started after August 1, this will affect. So let's get started on this one. I'm going to bring in Mark Taupeka. Mark Taupeka is actually one of the three attorneys that owns Orange Beach Title. There is a fourth partner. These guys have been practicing law for years. Okay, 2 decades, right, Mark?
Yes, 20 to 25 years, Shane.
Fantastic. They own Orange Beach Title, which is new to Orange Beach, Alabama, but they've also got an office over in Fairhope. I think they're under a different name. What's your name over there?
Well, the law firm name is Cassidy Taupeka, and we will be performing closings in Fairhope under the name Eastern Shore Title.
Okay, Eastern Shore Title. Okay. This guy I met at the office a week or so ago, and he was kind of bringing me up to speed. I knew this was coming, but I didn't realize how significant these changes were. And kind of after Mark came in and explained just a few of the small changes, I knew I needed to get him on the show because this is information that as I'm walking around, I'm finding people do not know. I want to apologize up front. Typical Florida weather. Here it is at 10 o'clock in the morning on a Tuesday, and the thunderstorms are showing up. So if you hear a little lightning and thunder in the background, just wait 10 minutes. It'll all change. Don't worry about it. Mark, let's get started. Tell me a little bit about what's going on. Let's go back to, this all came from the mortgage crash, correct?
Yes, it did, Shane, and let's go back in history for those that have been involved in real estate over the years, or even if you're new to the game. Back in the first half of the 2000s, the market was blowing and going. It was red hot. Real estate was appreciating at astronomical rates, and largely because the stock market had fluttered a little bit. And we had seen the dot-com boom, and investors were looking for the next big thing. Well, they found it in real estate. And so they started buying up real estate all across the country, and in particular in coastal communities. For example, South Florida was an absolute feeding frenzy. And then that started to make its way up the Gulf Coast and even into our markets here in the panhandle of Florida and coastal Alabama. Well, as all good things do come to an end, it came to an end. It was really Katrina was the icing on the cake. A lot of people think Katrina in August of 2005 was what did it. Actually, the real estate market was somewhat of a house of cards waiting to collapse. Credit was loose. Anyone and their brother were putting down a letter of credit with no money down to buy a pre-construction condominium, and the banks were allowing them to do that. And credit was just simply too loose at the time. And then in 2005, when the economics couldn't support that, you had Katrina, like I said, was the icing on the cake. And you had basically it was like the demand was like a spigot being turned off. It was just that dramatic, that night and day. And with that, everyone, of course, in the governmental communities were pointing fingers at one another. Was it the banks? Was it the lenders? Was it the realtors? Was it the investors? Who caused all this? And at the end of the day, or was it government? And at the end of the day, we ended up with the Dodd Frank Act in 2010. And the Dodd Frank Act in 2010, one thing that it did was create the Consumer Financial Protection Bureau, because government decided that consumers need to be better protected. And it used to be that when we had a closing transaction, you would end up with a HUD-1 settlement statement. And, of course, that was administered by the United States Department of Housing and Urban Development. With the Consumer Financial Protection Bureau and the TILA-RESPA final rule, which is effective August 1, 2015, this all changes. And when I say TILA, what is that? Truth in Lending Act. And when I say RESPA, what is that? Real Estate Settlement Procedures Act. Both are designed to protect consumers and to inform consumers as best as we can. Now, like most things in life, the pendulum swings too widely one way or the other. Regulations were too loosey-goosey before 2005, and now the pendulum swings so that it's. You talk to any mortgage broker, mortgage lender, closing agent, and now realtors, and you're going to find that we're going to spend much more time in paperwork and trying to do the things that we used to do. And it's just going to take longer to do them. They can still be done, but it's just going to take longer to do them. And what is happening on August 1st, and it's a drop-dead date. It's not like there's some kind of phase-in, where you have concurrent systems or procedures and processes going on. It is a drop-dead. This is what happens on August 1st. On August 1st, rather than having a HUD-1 settlement closing statement, you're going to have what's called a closing disclosure. And there is a 5-page buyer/borrower's closing disclosure, and then there's a 2-page seller's disclosure. I guess if there's any good news here, Shane, is that for cash closings and for commercial closings, we still get to use the old familiar HUD-1 settlement closing statement.
And Mark, let me ask you a quick question. Since you brought up those two exceptions, there were a few other things that I had found a little bit of my research, but you're the attorney, so I'm going to defer to your expertise. It also says that reverse mortgages, home equity lines of credit, mobile homes, or by dwellings that are not attached to real property are still going to use the old. Is that still correct, or is that wrong?
That is correct, sir.
Okay.
I was using the two major examples.
Sure. The cash deals.
Yeah, the cash closings and the commercial closings, but you are correct. The other ones that you listed, there is a laundry list of those that will not have to use the new closing disclosures, but can still use the old HUD-1 settlement statements. And some of the examples that you mentioned are in that laundry list.
Okay, fantastic. Sorry to interrupt.
Hey, no problem at all. So any closing after August 1, 2015, residential closing where there is financing involved will have to use the new procedure.
Okay, Mark, one more quick question. And this is, again, I want to defer to you. So let me just ask it. Because I see, as I was researching, getting ready for this interview, I see a mixed bag of things saying that if the closing happens on August 1, the new form happens. The other side of that pendulum or coin that I'm seeing is if the loan starts August 1. Do you know which one it is?
Shane, I have to be honest with you. I am not certain as to which one it is.
Okay.
And the interesting thing about this is that the onus is put on the lenders. The lenders are the ones that are directly regulated by the Consumer Financial Protection Bureau, and they've been told that this is the procedure they need to follow. And they've also been told that you can hire out third parties for certain things like a closing agent. But, oh, by the way, you're going to be responsible for them. So, and that's in terms of the closing disclosures that we mentioned. In other words, the lenders can allow closing agents, title agents, whomever, to complete the closing disclosure forms. But at the end of the day, the lenders are the ones that are going to be responsible for what's on that form, right or wrong. And so what you're going to see is that lenders are going to do this in-house, and they are going to require folks like closing agents, title agents, realtors, et cetera, to provide them with information several days in advance. And when I say several days, I mean at least 7, if not 10, if not 14. And we all know, Shane, in this business, that a lot of things, get put on the back burner until the last few days before a transaction, if not the last day, if not the day of a transaction is supposed to close. That's not going to happen now. That cannot happen now because the closing disclosure forms, they must be final and provided to the buyer/borrower 3 days in advance of closing. And if there's a material change to that, then a new 3-day clock is started.
Okay, let me back up because that was a whole lot of information really fast. So let me see if I can understand this. And for those listening, make sure we all get this. The way it works kind of now, I have a closing today that I know that the survey was ordered 3 weeks ago, but surveyors are running 2 to 3 weeks right now. So the survey got done over the weekend. It's being delivered to the title company today for the closing to happen today. Obviously, that won't happen under this new rule. We would have to wait until next week because that has to get on the closing disclosure, which has to be created by the lender, not the title company anymore, and then has to be provided to the buyer 3 business days, correct, Mark?
That's correct.
Okay, 3 business days prior to closing. So now instead of closing today, I would be closing at the earliest next week.
I'm going to say that that's a general rule, Shane, but it's not necessarily the case. If, for example, the closing disclosure had a line item for a survey and had an approximate cost, an estimate, let's say, and so it's not necessarily that the survey isn't delivered until the day of closing. It's the cost thereof needs to be on the closing disclosure 3 days before closing. And if the cost changes slightly for a survey, then there's kind of a de minimis rule or an immaterial rule, and I would not think that a change in the cost of a survey within 3 days would start a new 3-day clock.
So there are some exceptions. And I don't mean to cut you off. There are some exceptions to these things, but let's back up for just a second because this is important, and I don't want to skip over this or skim over this. There's going to be, in your opinion, and in mine too, just from the research I've learned, there's going to be a shift of preparing closing documents from title agencies to lenders now, correct?
That is correct.
Okay, so if that shift happens, and I can tell you from the hundreds of closings I've done over the past, 2 years, 3 years, many of them, and I don't want to put a number out there, but many of them, the lender is prepping the packet, we call it, to send to the title company so the title company can prep the HUD or the closing statement, and sometimes they're sending it out the same day. So now we're adding more stuff. We're actually kind of taking some stuff off of a title company and putting it on a lender. Okay, so Mark, let me ask a question. With all that going on, obviously the title company's role is going to be to issue the title insurance, which is huge. Researching the title, issue the title insurance, that's huge. They're there to facilitate the closing, meaning the physical location, correct?
Correct.
Okay, and the lender is really going to kind of take on more themselves, correct?
That's correct. I expect they're certainly going to be responsible for it. There's no doubt about that. And I think that you will find lenders take a more active role in actually preparing these closure disclosure forms. And as we talked about earlier, typically in the past with the HUD-1 settlement statement, lenders did not do that. They would provide a loan package to the title company closing agent and allow the title company and closing agent to prepare the HUD-1 settlement statement and send it to the lender for the lender's review. Those roles are going to be reversed somewhat, I think. You're going to see lenders taking a more active role, a more primary role, and some lenders that work exclusively with one or more title companies and closing agents may actually allow the title company and closing agent to, let's say, prepare a first draft of the closing disclosure forms. But ultimately, at the end of the day, the lender's responsible for the closing disclosures, and they're going to make sure that that they agree with what the numbers are, whether they do it in-house completely or whether they do it with the collaboration or assistance of a closing agent or title company.
Okay. All right, so that makes a little more sense. I think one of the big things that I want to point out is that this whole process, although we will get used to it, I think in that small term, the second half of 2015, there's going to be a delay because everybody is getting used to it. And I think Mark would agree with me that if you are selling your property or buying property in the second half, starting, depending on if it's, closing after August or if the loan has to start in August, either way, I would say starting July 1. So what is that? 5 weeks from now. If you go under contract within the next 3 to 5 weeks, then I would anticipate a longer than normal closing just for this. Mark, you'd put that August 1 was a drop dead date, but there is going to be a ramp up for everybody that's just getting used to it. Although we have to do it now, there's going to be a time frame. What do you think loans should take or a closing should take now? I'm thinking 45 to 60 days.
I think you're right, Shane. Whereas we used to be pretty confident we could go from a fully executed real estate purchase and sale agreement to closing within 30 days. I think if you're a player in that, if you're a buyer, if you're a seller, if you're a realtor, you have to expect that it may take longer. And 45 days to 60 days, I think you have to think that it may take 60 days, and more than likely will be more or less 45 days. So I agree with you, Shane. I think that's the window we're looking at.
And a lot of that time frame, I think, is coming because we've got to have these disclosures the way they've always supposed to be. I mean, I don't want to beat up on government oversight, although if they get in things, usually muck things up, but. A lot of it, we were supposed to get closing documents 3 days in advance, right? I mean, that's how it's supposed to be already. We're supposed to see a HUD 3 days in advance. The industry just kind of shrugged that off. So now it's almost like we're being pushed and forced now. Hey, listen, and I think that closings are going to go much smoother. I think that people seeing stuff, having the 3 days now, that's just going to make the closing, the physical closing, much smoother because all the paperwork's been seen.
Right, and I agree with you, Shane. It's not all bad, right? It seemed like this industry needed somewhat of a kick in the pants, and it got it. Certainly all interested parties in a closing like to see the closing statement in advance of the closing, and you're right. Sometimes we don't see them until you walk into the closing room, and it should not be that way. Everyone should have advance notice of what the transaction is and what the inflows and outflows are and all that kind of stuff. And so I think making it mandatory that it's 3 days, that's not a bad thing. That is not a bad thing. I may personally take issue with the forms themselves, the new forms we're going to have. We have two different forms, and I'm not sure why we need to have two different forms, but we do. We've got a 5-page closing disclosure form for the buyer/borrower, and we have a 2-page for the seller. and unfortunately, there may be instances in which the numbers don't exactly match up, and in that case, there may be a third closing disclosure form, which would be very much like the old HUD 1 settlement statement, that may need to reconcile some of the numbers that are on the buyer's form versus some of the numbers that are on the seller's form.
Give me an example of what you mean by that, because and I'm sorry, I've been doing this so long, and I'm kind of set in my ways, but I'm trying to transfer over. I'm used to the HUD 1, so I'm used to the current closing statement. It's all debits and credits. I mean, it's an accounting person's dream, because it's all debits and credits and it equals zero.
Right. And when they don't balance, then you know that there's a problem.
Right. Exactly. So
and that's still true. But here's the one example I can give you, which is going to be interesting, and it has to do with the lender's title insurance policy. The lender's title insurance policy is currently and will remain the cost of which a fraction of the owner's policy. And this is assuming that whenever there's a lender's policy, there's an owner's policy. And I am going to assume there's always an owner's policy when there's a lender's policy. And even if there's not a lender's policy, if the transaction is not being financed, in my view, as an attorney, there should always be an owner's policy for protection's sake.
Yeah, and my view as a broker, I'm going to agree with you. There's 100%. That's one of the few things I tell my clients: you don't have a choice. You just have to do it.
Exactly. So if let's just for round numbers, if there's a lender's policy and an owner's policy, and let's say the cost thereof is $1,000. That's the total cost thereof. And in reality, let's say the owner's policy is $800 and the lender's policy is $200. The problem is that what the Consumer Financial Protection Bureau is saying on the buyer-borrower's closing disclosure form, the lender's policy must be shown as if there were no owner's policy. And in my example, the lender's policy might cost $800. And so the buyer's disclosure form, borrower's disclosure form, must show the lender's policy at $800, even though it's actually only going to be $200 for the buyer/borrower.
And that's for the reissue credit, right?
Yes.
Okay.
Yes. And because we know that's going to be the case, that there's going to be an owner's policy and there's going to be a lender's policy, and we know that the seller typically pays for the owner's policy, and we know that the borrower typically pays for the lender's policy. Now, if that were to change such that the borrower would buyer/borrower would always pay for both the lender's policy and owner's policy, then we wouldn't have this problem. But I expect that norm not to change, so that the seller pays the owner's policy and the buyer/borrower pays the lender's policy. And because that number is going to be, I guess it's disclosing what the true cost of the lender's policy is, but it's not disclosing what the actual cost is for the buyer/borrower. The buyer/borrower is only going to pay $200, whereas that form is going to say $800, and we're going to need to reconcile that on another form.
Oh, fine. Okay, and let me clarify for some of the listeners that we may have lost when I said reissue credit. Basically, when you get a policy, when you buy a property and you have an owner's title policy, that's to protect the buyer. If something comes up on the title that makes the title not marketable, they can go back to that title insurance and say, correct this. And then the lender who is lending you money wants their own title insurance policy or insurance policy for the same reason. But a title company, because they run one search and they know that they're good and they're going to issue the owner's policy at, to use Mark's example, $800, that means that title insurance on that property is $800. But if they simultaneously issue a lender's policy, they will give you a discount for that. Correct, Mark?
Correct.
Okay. So that discount is what he's talking about, but under this new guideline, the buyer's going to have to show for the lender's policy, because that's what the buyer's paying for. The seller's paying for the owner's policy. The buyer's paying for the lender's policy. They're going to have to show the full $800 but the lenders or the sellers are seeing the lender credit of $200. So there's got to be another form that lets everybody know where that $600 discount's coming from, correct?
That's correct.
Okay. And that form is what?
That form is yet to be determined. Interestingly enough.
Oh, perfect.
Yep, the Consumer Financial Protection Bureau created the 5-page buyer/borrower closing disclosure, the 2-page seller closing disclosure, and let's not forget, we passed by this because we went straight to the closing table, Shane, but let's not forget the 3-page loan estimate that a lender must disclose to the buyer/borrower, and that is in lieu of the old good faith estimate and truth in lending disclosure. So what used to be from a lender a good faith estimate and a truth in lending disclosure, 2 separate forms, is now rolled into one form called the loan estimate. And of course, realtors like yourself, Shane, you guys will still be doing your own good faith estimates the way you've always done them.
Correct. Yeah. All we do is kind of break down, but ours is so much. I mean, we break down as best we can, but ours is so much to be determined that it's tough to really go by. So I always tell the folks to check the lender's good faith estimate, but now that's called a loan estimate. And if I'm not mistaken, they have to give that within 3 days of application.
I'm not exactly sure of the timing on that.
Okay. I'm pretty sure of that. I'll triple check and I'll put it up in the show notes, but I'm pretty sure it said 3 days of, which is normal. That's not changed. You had to do good faith estimates within 3 days of application anyway, so just changing the forms, the time frame hasn't changed, so that's normal. But okay, so we don't.
That makes sense. And so just to cover the last topic or wrap it up, the answer to the question of what is the form that is going to reconcile the 2 closing disclosures at closing, and the answer is there is none. The Consumer Financial Protection Bureau did not listen to the title insurance industry, who jumped up and down and saying and let them know this is a problem. It's going to be a problem. And it just went in one ear and out the other. And so that's why I say there likely will be the use of the old HUD-1 settlement statement for any reconciliation items between the buyer/borrower closing disclosure and the seller disclosure, closing disclosure. And the one main area that I can think of is the cost of lender's title insurance policy.
Okay, so that makes sense. So basically all this is going to do in the interim until we get better guidance is going to be, not only are you going to get a HUD-1, but you're going to get a seller's closing statement and a buyer's closing statement, but we're still going to have to go back to the old HUD-1 just to reconcile the new forms that the government just put out, right?
That sounds about right, yes.
Perfect. Okay, Mark, I can't thank you enough for coming on, man. Is there anything else that listeners need to know? I know that we've got some real estate agents on that listen. I know that we have some title agents on. I know that we have consumers on. Is there anything else they really need to be knowing except for prepare for extra time because everybody's going to be getting used to this?
You pretty much summed it up, Shane. Prepare for change. Prepare for more time, and prepare for a period of transition, and hopefully after we've been doing this 6 months, maybe a year, up to 2 years, what have you, the Consumer Financial Protection Bureau will get feedback from the industry and all the players in the industry, all the participants in the industry, and then maybe things will be tweaked somewhat. I mean, who knows? But we're all in this together. We all got to live through it. If you have not gotten training personally via your office or individually, I'm sure there's plenty of information out on the web. There are courses that can be taken in person, live, or online, or what have you. So it's coming August 1st, folks, and just do what you can to ramp up and get up to speed and know it's coming, because it will be here, as you say, in a matter of weeks.
Absolutely. For the consumers out there, make sure whoever you're working with, real estate agent, lender, that they understand this. If you've listened all the way to the end of this podcast, you know more right now at the end of May than probably 60% of the quote-unquote professionals I've talked to around town, because a lot of people know that something's coming but hadn't taken the time yet because we're still coming out of that spring buying season, and so they just really haven't sat down and looked at it. When I heard this, I personally just heard it really a couple of weeks ago. I knew it was coming in the back of my head, but as I saw the major differences when Mark came to the office, I wanted to make sure I got this out to you guys. If you're a real estate agent, that's the training that he was talking about, title agent, whoever, attend the training. I know the local boards are putting on a lot just because of it. There's a ton of webinars online. After you've listened to this, I am going to put all the old disclosures and the new disclosures in the show notes. So look for that, and I'll link that to it. That way we can see kind of the differences and hopefully put some of the time frames. Mark, thank you so much for coming on. I know you've got to go. We're already over for both of us. So any final thoughts?
Well, Shane, I really appreciate the opportunity to be on the show with you this morning. And if anyone has any questions for me, again, it's Mark Taupeka, and I can be reached at Cassidy Taupeka Law Firm in Orange Beach, and also Orange Beach Title in Orange Beach.
Okay. And if it's okay with you, I will put your email and office number in the show notes. Is that fine?
Yes, sir. Of course.
So that brings us to the end of this episode. If you want to find those forms or those links to those forms, make sure you visit the site. It's shanewillis.com/podcast/changes. If you made it here, I really appreciate it. Hopefully you learned something. We'll see you on the next episode.